side first. When you talk about a call option, you're talking about a contract between a buyer and a seller for a specific period of time. A buyer of a call option, you have the right but not the obligation to purchase 100 shares of stock at a specific price by a specific date. The key to remember, when you buy a call option, you're taking a bullish bet, but the moment you buy that call option, the time decay is going to hurt you. It's a decaying asset. Every day that you hold that long option, it loses value. Not only do you need a move to the upside to make money, you need that move to the upside to happen fast enough. If it takes too long, or if the move is not big enough, you're not going to make money with a long call. Doesn't make it a bad strategy. You just have to be very selective when you use it. You've got to have a very strong directional outlook. You've got to have a very strong bullish outlook to make money with that strategy. So when you buy a call option, you are considered long the option and long the position. You have that bullish outlook for the stock. The seller of the call option, on the other hand, if you buy a call option and you're bullish, there's got to be somebody on the other side of your trade willing to sell you that call. Again, we'll take both sides. We'll talk about that more in just a bit. The seller now has the obligation to sell 100 shares of stock at a specific price when requested, up until a specific date. So if you sell a call option, you're expecting the stock to move lower. Let's say it moves higher. You're dead wrong. You're going to have to deliver on your end of the bargain if requested. So we'll talk about how you can limit your risk in that scenario. There's definitely ways of making sure you don't get hit with a large loss in those types of situations. But you just have to know that as a seller of a call option, you're considered short the option. You're also considered short the position. So you want that stock to move lower. Selling a call option is a bearish position. A put option, on the other hand, call options are very basic for most newer people to understand. The put option is when it starts to get a little trickier, at least initially, for somebody that's brand new. Because a put option is actually, if you buy a put option, it's a bearish position. You're buying an option contract that makes money as the stock moves lower. It gives you a ton of flexibility because now I don't care if the market moves higher or lower. We don't need a never-ending bull market to make money. If the market starts to head lower, we can buy a put option to make money as the stock moves lower. So as a put option buyer, you have the right but not the obligation to sell 100 shares of stock at a specific price by a specific date. So now we're just controlling the downside. We're considered long the option, but we're considered short the stock. So we're short the position. You want that stock to move lower. The seller, on the other hand, again, somebody's got to take the other side of the trade if you're buying a put option, and that seller has the obligation to buy 100 shares of stock at a specific price when requested. So if the stock, let's just say you sell a put option expecting the stock to move to the upside, and it doesn't, and that stock moves lower, you've got the obligation to deliver your end of the bargain. And you've got to deliver those shares of stock if requested. So again, it's not a huge deal. It's not a deal breaker. There's certainly ways that we can limit our risk with that approach. We will certainly sell call and put options. We just do so as part of a vertical spread, which we'll talk about in just a moment. Now, a standard option contract gives you control of 100 shares of stock. There are some mini options out there. Highly recommend that you stick to the standard options. They're going to have much better liquidity. You're going to find it much easier to get in and out of positions quickly and at good prices. The option price quote, when you look at them, they're going to be quoted, when you take a look at it, it's quoted per share. It's quoted per contract, but it represents a per share basis. So what I mean here, if you buy 10 contracts and those options are quoted at $1.25, you're going to take those 10 contracts, multiply it by $1.25, but then you have to multiply it by 100 because every contract represents 100 shares of stock. So your total cost here to buy 10 contracts would be $1,265. It'd be equivalent to 1,000 shares of stock. So when you see an option trading for $1, it's not going to cost you $1 to put that position on. It's going to cost you $100 because every contract represents 100 shares of stock. So a lot of times people, they'll come in and they start to trade options and initially, and they start to trade 10, 20 contracts, and that's fine as long as you have the account size to back it up, because you put on 10 contracts, all of a sudden that represents 1,000 shares of stock. You just have to understand the risk side of things. And a lot of times newer people overlook that. They just get so enamored with the profit side of things that you lose sight of the risk. There are monthly and weekly options available. You've also got you've got some quarterly cycles as well. We trade a majority of our positions with weekly and monthly options. The monthly options will expire on the third Friday of the month. The weekly options, as the name implies, your trading options that expire every week. So we'll use a mix of both. I'll talk about the sweet spot, and how much time we like to look for before expiration. Again, we'll use a mix of these. Just know that the monthly options will always have better liquidity. They're going to have better volume and better open interest. It's going to make them easier to trade. The weekly options, they're nice in some cases. We'll use them. You just have to be cautious with certain products because the volatility, the volume and open interest is not as good with the weekly. So it can be a challenge to get in and out quickly and at good prices with some of those weekly cycles.